Welcome to the podcast about investing in startups, where existing investors can learn how to get the best deal possible. And those that have never before invested in startups can learn the keys to success from the venture experts. Your host is Nick Moran, and this is The Full Ratchet.
Welcome to another special release of Investor Stories. On this installment, the experts discuss a startup that they did invest in, what the key factors were that led to yes, and how that investment has worked out. Here's the segment called Why I Invested.
On today's special segment, we have Leo Polovets of Sousa Ventures. Leo, can you walk us through a situation where you did decide to invest, what the key factors were that led you to yes, and how that investment has worked out so far?
Sure. So my fund invested in this company called LendUp out here in San Francisco. And what they do is they have a much less predatory and much more synergistic approach to helping people who need payday loans. So the way that industry works today, or the way it worked until a few years ago especially, is people go to like the local check cashing place, they borrow like $200 to pay their utility bill or whatever, and then a few weeks later they have to pay back like $300, and it was a pretty exorbitant rate for a short-term loan. LendUp is an online provider of short-term loans, and what they do is first they educate you, they tell you exactly what kind of loan you would get, what the rate is, what your alternatives are depending on how long you want to borrow the money for. But they also track your behavior. They see how much time do you spend looking into the terms of the loan, or do you just try to get as much money as you can as fast as possible. They also look at repeat usage. So for these existing payday lenders, if you borrow from one once, you come back tomorrow, they give you the same rate for the same loan. LendUp actually uses historical data. They say, you borrowed from us 3 months ago, you paid it back. Hey, we'll give you a bigger loan with a smaller interest rate. And they keep doing that so that they call it the LendUp ladder, where basically after you've paid your loans off a few times on time, you're actually getting really, really good rates relative to what you could have been getting before. So my partners and I really like this because the founders are amazing. We really like the mission of taking a predatory market and making it not predatory, and in fact, LendUp even reports back to credit bureaus, so it helps somebody rebuild their credit. And then I think the data advantage was something we really appreciated too, which was not only was LendUp making better decisions because they were using data, but also the more loans they issued, the more they saw which ones got repaid and which ones didn't, the better they'd be able to issue loans and predict credit in the future. And they're doing super well.
And they're actually able to get the cash to folks that clearly they need the cash on demand if they're going to payday lenders already. So they're able to get that transaction cleared in quick order.
Yeah, and what's interesting is, so the way people find these lenders online is they'll go to Google and they'll search for payday loans San Francisco, and they get 20 ads from AdWords, and they just start clicking through them one by one until one of them says, okay, you're approved for a loan. And one of the interesting things is because the existing payday lenders don't use sophisticated credit models, they all kind of use the same simple model, and so let's say that they can give loans to 50% of people and the other 50% don't pass the model. Because LendUp uses data and they can make better decisions, maybe they can issue loans to 60% instead of 50%. So that means there's 10% of people where LendUp has a monopoly, because those people will click through the other lenders, get rejected, and then when they click on LendUp, they get approved. And then after that, they start using LendUp more and more. So it's a great business model in a lot of different ways.
Anything about the founding team there? Did they have some background in the lending industry?
It was a great combination. If I remember correctly, I think the CEO, Sasha, had worked at the World Bank for a while and got really interested in microfinance. And so he had kind of the economics and the philanthropy experience. And then the CTO, Jake, was one of the early employees at Yahoo. I think he was one of the first 100 employees, and he actually joined while he was still in high school or just finishing up high school. So he was really good on the technology side. So it was a really great duo.
On today's special segment, we have Mike Collette of Promise Ventures. Mike, can you walk us through a situation where you did decide to invest, what the key factors were that led you to yes, and how that investment has worked out so far?
Yeah, sure. So, let's just keep with that high valuation theme. I'll give you a situation where we learned, a lesson of not making that the only variable and actually invested in something where we thought was high. And this investment was working out extremely well. So, we had several investments in teams or, in a similar area, in a similar stack. And so we knew the downstream markets very, very well. We were very familiar with the regulatory environment in this case. We were introduced a little late into the round. And so we sort of first came in saying, well, this is, it's going to take a little more for us to get in this if we want to do this because the val is high. But I remembered that earlier company that we screwed up. And so when we first met with the team, they just absolutely blew us away. I mean, in passion and energy and hustle, fit, vision, confidence. I mean, they had every answer to every question we asked. And then they gave us a spreadsheet with 6 tabs detailing more. I mean, it was fantastic. And the impressive part actually was just how thought out the founder was on where he was going and what the model looked like and the industry and the supply chain issues he was going to face and how to get around some of those. And so everybody in venture always talks about how important the people are. That variable, and that is the truth, that variable should be massively high in the formula. It's very big for us. And as I get older and older, I think it's almost all, frankly. But, so when a team jumps out and tackles you with that kind of enthusiasm and backs it up in an area that you're very passionate about, you just got to do the deal. And so we sat around the table and just said, we got to do this. Like, this is out of our discipline of what we normally do. But our job is to make returns, right? Our job is to create excess returns over above the market. And at times you got to go earlier than you normally do. And at times you got to go later. I mean, 85% of what we do is, pre-A, and some of it's pre-seed and some of it's later. So this was a later one, but it has been fantastic. And we hopefully learned our lesson the first time.
On today's special segment, we have Nathan Benaich of Playfair Capital. Nathan, can you tell us about a startup that you did invest in and why you chose to invest?
Yeah, sure. So the areas that for context, that we usually look at when we make an investment is team foremost. We look at the problem domain, then we look at the market and macro trends, and then we consider some competition. So with that framework, the business that we invested in recently that I'm one of the most proud of is a business called Mapillary, which is essentially creating an open source street view product where they take images created by a segment of users that are all enthusiastically mapping places in the world. So they're taking sequential images of paths that they cycle or walk down or drive. And then they're uploading these systems into Mapillary's servers. And Mapillary will then stitch all these images together and create a 3D visualization of that path. Now, like this problem, which is visually mapping the world, is just vast. And when you compare the differences in coverage that Google Street View has with others, really there's such a huge surface area in the world that is unmapped, and it's largely unmapped because there's sometimes no perceived economic value to mapping it because the cost to creating those maps is far too great because it's requiring very high cost camera rigs essentially that are being carried on the tops of cars, and those cars can only navigate on oftentimes like paved roads and therefore only focus on densely populated metropolitan areas.
Sure.
And really what you're seeing is that with the proliferation of smartphones and action cameras, one can take pictures of essentially anything. And if you create a scalable, democratized platform that allows the accumulation of this imagery and essentially a low-cost way of generalizing visualizations, and we think that it's an incredibly powerful knowledge set that otherwise isn't available. And on the team front, it's really one of the best teams that we think is fit for tackling this because one of the founders, a longtime computer vision engineer and researcher, built one of the first visual recognition companies, was acquired by Apple, and his co-founder wrote the Neo4j graph database, and the rest of his team are all excellent computer vision researchers and infrastructures engineers that are properly equipped with the tools to be able to create this kind of architecture that can deal with hundreds of millions and at some point billions of images and navigate this complex graph of images to create these visualizations. And as we mentioned a little bit during this podcast, which is the future of autonomous vehicles, we think that vision is one of the core technologies that can really enable this future to become a reality, and therefore mapping data is of incredible value, and really one of the only competitors in the space is Google. So for those reasons, we're particularly proud of backing this business.
That will wrap up this installment of Investor Stories. Head over to thefullratchet.net to leave a comment, sign up for the newsletter, or find resources discussed on any of the episodes. Until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks for listening.